Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, November 21st. We're recording at 4 p.m. Eastern Standard Time. Here's your starting lineup. Number 1, digging into the credit trenches. We released a report yesterday morning all about credit. We'll touch on that. Number 2, retail earnings. Home Depot, Walmart, and Target all reported this week. We've been sussing out the key takeaways from those big earnings reports. And number 3, the lightning bear market in technology. So back to number 1, a culmination of a month's worth of grassroots research has led to some conclusions. We've been triangulating with all of our resources about what is going on under the surface in the credit markets. And our conclusion is that there is no broad systematic downturn in credit. But we're also not sounding the all clear. There are some troubling signs. Our channel checks with our managers, strategists, traders that are in the market every day, analyzing public credit spreads, surveys, credit default swap markets, all of these things. We've used all these resources to try and understand what is going on out there. And we think that understanding credit markets makes us better as a strategist. Credit is the lifeblood of the economy. And if we don't have credit flowing, we're not going to have the economy growing. If credit is in trouble, equity is going to be in a world of hurt because credit is higher up in the capital structure. And we've seen this over and over in our career. When credit starts to struggle, it's only a matter of time until equities go down. We see credit as an early warning system for the equity market, really. So there are some signs of trouble out there in credit land. We've seen frauds, defaults, rising payment in kind in place of cash interest, pain in the low-end consumer, a weakening labor market, technology CDS costs going up dramatically. But there are also some positives. Public market spreads are still close to the tightest in history. Bank loan loss provisions are not going up. The Fed Senior Loan Officer Opinion Survey was benign and showed stability. We know the Fed is continuing to cut interest rates and probably will again at the December meeting. The NACM credit survey was indicating positive credit conditions. Liquidity is good in the marketplace. You can transact. Things have not dried up at all. And usually when credit gets in trouble, it's difficult to get trades done. And that's absolutely not the case today. And the technicals remain really strong. There's an underlying demand for yield in this market. We also know from talking to our managers that credit underwriters are increasing vigilance. Now, that's bad for growth at the margin, but that's good for future returns, and it's an indicator of lower defaults in the quarters ahead. So our managers tell us there are still plenty of opportunities to originate good credit with high returns per unit of risk. And the one thing that was really hammered home to us from this months-long analysis is that it really matters who your credit partners are. Only 1 of 8 of our credit counterparties was stung by any of these recent defaults. And this is why we spend months and sometimes even years getting to know and diligencing our partners, because we're going to be with them for years. And when you know you have excellent, well-aligned partners like we do in credit, it gives you strong hands to be able to deploy capital into highly uncertain markets like the ones that we face today. Now on to retail. We dug into all 3 major retail reports this week, and 2 of the 3 of them were weak and negative reports. There's really a wide dichotomy of performance year to date in these big 3 retailers. Home Depot down 14% year to date, Walmart up 18% year to date, and Target down a woeful 42% year to date. What we gleaned from listening to all 3 of these was that consumer divergence is visible in the earnings. So value essential retail items like the kind they sell at Walmart are still in high demand, while discretionary and high ticket items, the kind they sell at Home Depot and Target, are strained. They're in lower demand right now. And the Walmart CFO cited an ongoing, quote unquote, affordability crisis compressing consumer budgets. Housing and big ticket spending is just plain soft. The housing market weakness continues despite rate cuts and despite lower mortgage rates. The consumer is growing more cautious. There are fewer trips to retail. There are lower ticket purchases going on right now. And the low-end consumer, as we've been saying for a while now, is under extreme pressure. And they are very pessimistic. And we saw that again today from the final University of Michigan Consumer Expectations Survey for the month of November. So Target told us not to expect a good holiday season. To quote them, the consumer is just getting by. And obviously, the recent equity market sell-off is not going to help Christmas sales over the key Thanksgiving holiday. Now, finally, the lightning bear market in technology. As of this morning, the NASDAQ 100 index has suffered a 9% correction in 17 trading days. That's pretty swift, and why we call it a lightning correction. The carnage below the surface is just absolutely devastating for speculative tech companies and AI-related technology companies. But even behemoths and Mag 7 companies like Meta is down 27% over the last couple of months. Oracle down 44%. Palantir, which was the best performing stock in the S&P 500 for the year, down 30% in the last month. Dell, an old school technology company, what I would call a value technology company trading at 12 times earnings, is down 30%. CoreWeave, a pure play on AI-related spending, down 65%. Rigetti, a quantum technology darling, down 65% in the last month. And Circle, arguably the hottest IPO of the year, down almost 80% since June. So the common thread here is AI capital spending. There's just been too much of it too fast. These big hundreds of billions of dollars in deals are just no longer credible. And what we've learned in this industry for over 35 years is that when capital expenditures get excessive, returns on invested capital suffer and equity prices go down. So stocks are going down hard on these new AI investment announcements, and the cost of insuring investment-grade credit portfolios is going up dramatically. Oracle's a good example. CDS protection for 1 year went from 40 basis points a few months ago to 112 basis points today, almost a tripling. So who will be the first company to dial back CapEx? I'm curious who that will be, but I would venture to say that their stock price will rebound when they throttle back because it's no longer credible. So the damage has been done. A bear market has just happened for a lot of the tech sector. It's too late to sell. And Jim Breyer taught us that when the great technology franchises, and we believe Meta and even Oracle are two of those, when they go down by 25 or 30%, you're supposed to buy. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.